Hello, everybody. We're going to give it a minute to let everybody log in, and then we'll get started. Looks like people are still zooming in, so I'm gonna wait another minute or so. Okay. Oh, still going. This would be a perfect time to have some of the music playing, you guys.
I was going to say, you could also apologize to the attendees for misleading them about our dressing up as New Kids on the Block or 80s gear.
Wait, who? No
that
one.
That was in the ad, I think. It was
No.
the old, yep, bait and switch.
I mean, I could, if everybody wanted, I could play some New Kids on the Block on my phone as intro music.
Are you actually technically savvy enough to do that?
We realized that we should have had a question at the beginning just to see who all actually realized that we were referring to or referencing New Kids on the Block in all of our posts and everything. If you did.
Oh, someone
has gotten it. I think the first polling question should have been, did you own a New Kids on the Block CD or go to a tape? I'm sorry, tape, or go to a concert.
Can you hear this?
I think you can only play 15 seconds of that, I think.
Yes, yes.
There you go. All right.
Please, no, people are asking us not to play that, so let's move on.
That means we're definitely going to do that. Okay, I think we can get started. The number seems to have reached a point where there's no increases. So I think we're all here. Wonderful. I want to thank everybody for joining us on this week's webinar. We have I'm Breen Schiller. I almost said my maiden name. That's weird. I'm Breen Schiller from HMB, and this week I have some very special guest stars joining us on our gross receipts tax presentation, The New Kids on the Block. I will even say my good friends, Steve Jasper from Bassberry Sims in Nashville, and Nikki Dobey from Cost, she is actually out in Portland. And today we are going to talk to you about gross receipts, and I thought who better than to have the two of them who are intimately familiar with two gross receipts tax. Steve, one that has been around for a while, even though a lot of people, as Steve will explain, don't realize that the Tennessee business tax has actually been around for quite some time. And Nikki, who not only is familiar with the Oregon tax, but also was instrumental in testifying before the Oregon legislature in their passing and trying to help steer them in the right direction. So just a few.
All lies.
These are all good things, we have some, we're even saying, people are saying that they're in the chat function, people are saying that their kids were fans, and that Stephanie has said that they're experiencing a comeback.
Yeah, so. I think that's right. I think they've come back and now they're plateauing and staying at that same moderately popular level.
And I believe that's about the New Kids on the Block, the band, not gross receipts taxes. Although it could be said about both.
Maybe her daughter might have been a big fan of gross receipts taxes.
Right.
Yeah.
That would be weird, but
Just a few housekeeping items. One, there is a Q&A function and also a chat function that you can use. If you have a question, we will be monitoring the Q&A, but it looks like people are also very familiar with the chat function. So we will just keep our eye on both of those if you have questions. Also, if you're having any technical issues, please reach out to Hillary. She's one of the H&B marketing people. Her email was on all of her email address was on all the marketing emails that went out. And also she is on here, but she is just muted. So you can use the chat function to reach her if you need. So we already have a question.
will Tennessee be discussed?
The answer is yes.
It will.
It will be the first portion of our presentation, pretty much.
Yes, Tennessee is going to be discussed. That's why I was saying that Steve is such a wonderful person to have on here, because he is located in Nashville and is very familiar with the Tennessee business tax. So the answer is yes. So to get started, I'm going to go through the overview with you guys. Just really quick, our agenda, I'm going to go over an overview of gross receipts taxes with everybody, trends among the states that we're seeing, and also policy considerations that are taken into both pros and cons when looking at the gross receipts tax. Nikki and Steve are then each going to take you through the quote unquote new kids on the block, the Tennessee business tax, although yes, we know it's not technically a new tax. It is widely unknown by a lot of taxpayers, and there have been some changes.
I think it's surprisingly old, which I think makes it the Donnie of the group.
Well played.
Thank you.
And then if we have time, we're going to go through some new developments of old taxes. So what we've seen in the news recently with the digital advertising taxes, some changes with the Washington B&O, and then just local GRTs that are making a comeback out west that Nikki could talk about. And so again, we're going to be, this presentation is to go over gross receipts taxes. In recent years, we've seen these, and I use recent loosely because looking back, some of these have been around for a long time, but the last probably 5 to 8 years, we have seen a growing popularity that states are using these as a revenue option for, to replace, they're looking at gross receipts taxes as an option to replace revenue that the states have lost to what they consider eroding corporate income taxes, because more and more you're seeing corporate income taxes, what the states would argue, being eroded by various deductions or carve outs for specific types of taxpayers or industries and other just expenditures. And so gross receipts taxes are seen as a viable option to those. And so that is what we are going to be focusing on going over. So first, to begin, I think we saw a Q&A. Did a question already pop up? No? Okay. So defining gross receipts taxes. So again, as I just stated, gross receipts taxes are generally broad-based taxes. They apply to receipts of a firm's total sales, and unlike corporate income taxes or sales taxes, they're applied to a firm's total sales without deductions for costs or taking any of that profits into consideration. And so states look at these as a much broader base tax. They're not adjusted for a business profits level or a business's expenses, and they apply to all transactions that a business make, generally speaking, across the board. And although this tax is technically imposed on the business that's earning the receipts, many times they are viewed as being just an additional cost on the consumer and potentially even the workers and shareholders. And I'll explain that in a minute why. But as prices as prices rise and as prices rise, generally the cost of this is is shifted onto consumers. And what we end up seeing when you're looking at the application of GRTs is that generally, for the most part, this impacts businesses with lower incomes the most. And again, although these are imposed technically or legally speaking, if you look at the enabling statutes, they're imposed on the businesses that earn the receipts. The tax effects of this, the tax affects the business's economic decisions as a whole in the response to the tax. So, for instance, a business could shift the cost of the tax forward onto its customer by raising prices. If a business is in an industry that can't increase the cost of its product for various different reasons, they could reduce workers' compensation. So we've seen in different states that have done analysis. The Tax Foundation did a very thorough paper on this a couple of years ago. It might be dated at this point. I haven't looked at it in a while, but one of the things that they found was that depending on the industry, if it was an industry that couldn't shift the cost onto the consumer, they saw a reduction in comp that they actually paid workers, or potentially could also reduce profits paid to shareholders, because somehow the business needs to make up that cost that it is gross receipts hits. And again, this all will depend on the industry and how sensitive a consumer would be to an increase in cost. So that rule wouldn't be generally applicable across all industries, but you are going to see, depending on the production, the consumer production. Again, there's no deductions for companies' costs, usually not subject to 86-272 or ASC 740 restrictions. And similar, as the slide said, to sales tax, but it is imposed on the seller, not the consumer. And also a huge difference is that it does not exempt business-to-business transactions. And that is something, in my experience working with taxpayers, like looking at the Washington B&O or the Ohio CAT, that is generally something that trips taxpayers up, the lack of the business-to-business exemption.
Well, and even being like in Washington, for example, where the tax is imposed at the entity level on every single entity, that's where you get into a lot of tax pyramiding.
Yep.
Because in Ohio, you can have a consolidated group where at least those intercompany transactions might be eliminated, but it really gets, it just keeps stacking up in some other states where they don't allow that sort of filing option.
Yeah, and that's Nikki raises a great point with the tax pyramiding, and along with that, you also see an increase of effective tax rate on taxpayers because of that. Again, you have, when you're looking at kind of the process of production, every level is going to have the gross receipts tax imposed, and so a part of that is going to be passed on to the next level, and it's just going to increase the cost.
I think a lot of people think of these, they are typically low rate taxes, but by the time you stack them on top of each other, and the fact that they're gross receipts taxes makes the actual tax liability can make it pretty significant.
Yeah, and I think that is why it's easier to get these passed, or why they could look very appealing to policyholder or policymakers that may not really understand the tax implications of it, because you have this broad-based tax, which again, if you think of our traditional sales tax, a lot of the sales tax bases are not broad, right? Like when you hear of a state trying to raise revenue, one of the things they always go to is, well, we can broaden the base because sales tax, you're not going to be taxing services. So you have these broad-based tax at this lower rate, but if you actually look in how it looks in effect, like if you were to take a chart of the same transaction and have a chart of the sales tax consequences versus the gross receipts tax consequences of the same transaction, the gross receipts tax, the effective tax rate is going to be much greater than the sales tax of the same exact transaction. And for those reasons that we talked about. So again, Steve, to your point, that is usually one of the pros that policymakers use to push these through. Is like, okay, look at that. We have this low rate, broad-based tax. but you're not really looking at the long-term consequences of that. Other pros, advocates.
We have a question in the chat. It's really more of a kind of a broad question about whether or not reimbursable expenses are typically included in the base. And I can answer, maybe Nikki can talk about it more globally, but for Tennessee, the answer is most of the time. If you are a receiving agent of receipts and have the duty to pass them on, or in some other ways can argue that that's not actually what you receive in exchange for what you're providing, then they would not be taxable, but otherwise they would be.
Yeah, and for Oregon, I believe the answer is yes, and that this came through a carve out in the technical corrections bill for returns and allowances, but I think it will just depend on each state and whether or not they have some sort of carve out for this type of receipt. So I agree with 100% with Steve's answer that it depends.
Okay.
And Breen, I before we leave the policy considerations, I would be remiss if I didn't mention cost.
Oh no, I haven't even started on this yet. Just yeah.
Well, I just was going to say, cost is, we have a policy position in opposition of gross receipts taxes for the cons listed on this slide. And, with respect to the pros, our rebuttal is, and we will see this when we start talking about Oregon, these are not always easy to compute. Oregon has really kind of missed the boat on that piece if they thought it was ever going to happen. But I think you very eloquently stated this idea that these are supposed to be broad-based, but we see that getting chipped away as states need more revenues coming in the door and because of tax pyramiding.
Yeah, so really quickly, I know I probably covered most of this already just in our conversation, but again, so advocates say, policymakers in the different states who have passed these or actually, offered them, these have been introduced in a lot of states that actually haven't passed them. These have been considered by a lot of states in the last recent few years. They say that they're simple to administer. I think the substance of our program, of our webinar will beg to differ with a lot of that. Broad base, they argue that the broad base will bring a stable source of revenue to the state because it's based on activity in the state, not profits.
And we do have a question about that. How is the tax less volatile? And I think that's a great question. The reason that these are seen as less volatile because they look more like consumption taxes than income taxes, where you do have large deductions. And for example, in the current economic situation we find ourselves, many corporations are going to be in loss positions for many years. So states are going to, have much lower corporate income tax revenues, whereas gross receipts taxes are seen as always maintaining kind of that baseline because they're more of a consumption-based tax, as well as you don't generally have NOLs with a gross receipts tax. So great question.
Yeah. So Larry, you asked that question, less volatile than what? And I mentioned a few slides ago that it's like Nikki said, it's generally compared to the corporate income tax. So to her point, and what we talked about a little earlier, is that when you're dealing with the corporate income tax, companies have the different deductions or carve outs, exemptions, exclusions, all, et cetera, that they can take advantage of at the different state level. And not that that's completely excluded, or that not that doesn't happen with gross receipts tax. There are states that do have enumerated deductions that taxpayers can take advantage of, but the general rule, right, is that you're looking at a much more broad-based consumption tax, and so it's looked at as less volatile in that sense.
I guess on that point, I'll add that the flip side con of that is that it obviously imposes a tax on a business regardless of whether it's profitable or not. And
exactly.
We've argued, although I don't expect it to actually succeed, that that's a reason why Tennessee should at least pause the business tax while we're all struggling with the COVID situation, because there's all these companies out there that are just trying to get by and are going to pay this tax regardless. So that's the obvious other side of the stability. Another word for stability is imposing a tax on the company regardless of whether it's successful or not.
Yeah, and that's a large con I'll get into in a minute.
Sorry.
No. You guys it's great. This is great. So again, going back, they say it's less volatile. The revenue collection is more predictable. Those are two of the huge, pluses that marks that would be in the plus column. Also, what we talked about earlier, GRTs generally have a lower rate. And this is, again, I would call this a little sneaky, like we said, because it is used as a way to try to get these passed. And they receive far less pushback. I mean, nowadays, I think a lot of people are more familiar with them, so they do receive more pushback. But earlier, when we were looking at years ago, when we were looking at the early ones being passed, the legislatures were looking at these like they were very attractive options. As cons, again, business-to-business transactions are not exempt. There's the criticism that the same economic value that is being taxed multiple times over, like we talked about, because you're taxing every stage of the production. And again, you're looking at that increase in effective tax rate. You have income, it's, as Steve was just saying, there's a larger impact on firms with low profit margins and high production volume, as the tax does not account for a business's cost of production. It doesn't account for a business's net income or profitability. It doesn't take any of those things into consideration. So this can result in distorting economic activity, again, magnifying effective tax rates. One industry or two industries that are, I guess you could say they're in the same subset, startups and entrepreneurial type of businesses who typically post losses in early years, sometimes face difficulties paying these GRT liabilities. So again, if you have a startup that has expanded really fast and they are doing business in any of these GRT states, this is something that could catch them by surprise. Again, GRTs don't account for a firm's profits or net income. And then efforts to mitigate, this is another huge con of the gross receipts tax. So efforts to mitigate negative effects of the GRT, such as like what we've seen states do in creating multiple different rates for different industries, often just result in increasing the tax's complexity and negating one of the primary reasons to enact it, in that, remember going back, that it's easy to compute, easy to administer. But what ends up happening when you have all these different rates, and we'll see it in a chart in a few slides, is that it has the opposite effect. It actually makes it much more complex. States tend to create different rates across different industries to account for different average lengths of production. You see this in the Washington B&O tax. They also can modify the tax base to accommodate different production inputs. And I think the theory behind this was to assist and help mitigate what Nikki referred to earlier, the whole idea of the tax pyramiding. But in turn, again, this just increases the complexity. And also, historically, there has been, studies done by some of the interest groups to show that it has actually increased in lobbying efforts of different industry groups to help lobby for carve-outs or preferential treatment under the existing taxes. And it could also lead to disputes, right? Because again, it adds to the complexity, adds a layer of complexity, and it leads to disputes between industry and states as to how a business should be classified, or also what constitutes, again, think of Texas with the margin tax, all of the costs of the COGS cases that have gone on in the last few years, the cost of doing business or cost of goods sold cases that we've seen. And all of these things are results from the different different things that have been done to try to mitigate things that states have done to try to mitigate the effects of it. And in fact, all just has increased the complexity of the actual administering of the tax. I saw something flash.
Angela asked whether there's actual uncertainty in the accounting treatment at this point. From my perspective, for the new taxes, or what we're calling the new taxes, including the Tennessee business tax, there is still uncertainty. When the real world situation is that there's one woman named Susan who makes the decisions about how the business tax applies in the Department of Revenue right now. And she is reasonable and nice and genuinely tries to get to the right results person. But also when you have such a undeveloped body of law and limited number of people who are in charge of administering that law, there is going to be still uncertainty, at least with these newer taxes or newly enforced taxes.
Yeah, and I think when we'll get to this with the Oregon tax, but for Oregon purposes, it is actually treated as an income tax for ASC 740 purposes because of the deduction. But I do know there were several questions about that in the beginning, and there have been different questions with some of the other gross receipts taxes that do allow for some sort of deduction, whether or not it is enough of a deduction to actually be considered an income tax for ASC 740 purposes. So I think it just depends on which of the gross receipts tax you're talking about, if there is any sort of deduction or not. So.
All right, so I'm gonna skip it. The next few slides are some charts that we wanted to give you guys that just compare the different gross receipts taxes that we have right now, the different thresholds that there are, as well as the rate structures. Again, remember when we were talking about the different rates and effective tax rates that taxpayers would be under, and then again, available deductions available. I want to make sure we have enough time. And also the filing requirement options for each tax. Keeping in mind, remember that like most taxes, nothing's uniform. So you have to, don't make assumptions based on your, don't make assumptions that based on your knowledge base of another one that it's going to be equally applicable to others. Okay, with that, I'm going to pass it off to Steve.
Sure. So actually, if you want to go to the next slide, and I'll try to go through this.
You wanted to talk about the basic purple one?
Yeah, right. And I'm going to go through this at kind of a high level. And I know there's likely to be questions about the business tax, and I'd rather talk about your questions than my summary. So please throw them our way at the Q&A or chat, and we will respond to them. But generally, as we've talked about a couple times, this is literally, I think, a centuries old tax that up until 2009 was enforced by the local county clerks or the city clerks. And because of that, it often wasn't enforced at all or was enforced sporadically. And no one really knew, how to apply the business tax. In my first 10 years of doing state and local tax in Tennessee, I had one business tax project. And currently, I have as many business tax projects as I do sales tax or F&E. And so it is now a real tax that people are struggling to get their arms around. And there's a lot of companies that have been doing business in Tennessee literally for decades who have never paid the tax, who are suddenly getting every single audit by Tennessee now includes the business tax audit, and they're suddenly getting.
Can I ask a question? So,
yeah.
So it used to be that it was just being administered at the local level, but now it's administered at the state level, or it's still administered at the local level?
It is still administered. Oh no, it is administered at the state level. You still have to get a local business license, but you actually submit your returns to the state, and the state enforces it and audits it. The state always had the authority to audit and to impose an assessment on behalf of the locals, but they traditionally didn't do that until 2009. They took it over. Then actually in 2014, they put more emphasis on being aggressive in enforcing it. And right now it's purely, it is a state imposed tax on behalf of the locals, I guess is how you characterize it.
Okay, thank you. That kind of answers a whole because that was the big question I had. It's like, where did it come from if it's been here forever? So,
yeah, no, it has. It was originally, not to get too deep into the weeds, but it was originally intended to be a supplement to the property tax for the locals. Mm-hmm. And that's why you'll see later there's an exemption for manufacturers that pay the property tax. But it's kind of grown into its own separate thing. And it doesn't give a ton of revenue to Tennessee, but enough to where they don't want to get rid of it. And so, yeah, they're now enforcing it. And then another thing worth pointing out is that unlike sales tax, the exact opposite presumption is true with regard to services, that most services, unless there's a specific exclusion, are subject to the business tax. And that can be surprising because it even catches intercompany services like management fee payments are actually subject to the business tax. And so things that you never would have thought about paying the tax on just because you're literally paying money between your affiliate for a service that your affiliate provides to you is subject to tax in Tennessee. If you want to move on to the next one.
I'm trying, sorry.
Is there a question? No.
It's about
yes,
Portland.
Okay.
I'll get
so this is really just kind of the basics on the business tax. The first thing to know is that the business tax is paid on the gross receipts of each business location. And I would say in Tennessee, but there's one exception to that. So you have to actually look at each location in Tennessee and see what gross receipts are generated from the activity at that location, and then calculate the tax based on that specific location. And this is sometimes confusing because the way Tennessee defines location includes a whole bunch of stuff that a lot of businesses would not think of as being their location. And some of them are listed here, such as if you have 2 employees housed at one of your customers that provide services to that customer, oftentimes like IT type services, that is a business location, and you have to get a business license and pay business tax for the revenue generated by those 2 employees housed at your customer. Similarly, if you have a fulfillment center or a warehouse in Tennessee where you just ship products from to fulfill purchases, that is a business location. And that can be a business location even if it's not your warehouse. So sometimes you might store a stock of goods at a third-party logistics provider or at a affiliate. And as long as you have title to the products there and then ship it from there to a Tennessee location and generate receipts from doing that, you're going to have that be a business location subject to the business tax.
And so Steve, how are they treating how are they treating the remote workers right now, like given our circumstances with COVID? Has Tennessee made an announcement in regards to the business tax to that?
That is interesting. You know, so a lot of times they have not is the answer. And a lot of times it is really, the business tax in a lot of ways is relatively easy to describe and then also hard to apply because people don't tend to literally just exist at one location and do their work there, you know, and so it's hard to know where to source or to treat the location as being, it's hard to know which location to identify as the one subject to the tax. And so what Tennessee tends to do, and I suspect they'll continue doing in the current circumstances, is to kind of latch on to any kind of physical location they can, whether that's an office you rent for your employees or their home office if they are there for a significant amount of time. I've only seen a home office taxed one time. Typically, they look for some bigger presence, I suppose. You know, although under the statute, I think you could literally look at each place where an employee is doing business, and if that employee is generating receipts, then it would be subject to the tax. Usually, if it's just a few employees at their house, you're able to find like a fulfillment center or another location where you can just as equally justify saying the taxes was generated or the receipts were generated from. And so I think you usually look for something like that.
And Steve, we have a question. It's someone is asking, I've heard that the Tennessee business tax applies only once at the state level for companies who only have economic nexus under the business tax, but that it applies twice at both the state and local level for companies who have a physical location in a locality that imposes business tax. Is this correct?
That is exactly right. Yeah, actually, that's the next part of this slide. So yeah, yeah, no, that's exactly right. So if you are outside of the state and have no location inside the state and currently ship more than $500,000 or generate more than $500,000 in receipts from deliveries of services or products to customers in Tennessee, then you're an out-of-state seller and you're only subject to the state level business tax. And that's true, actually, I should say, that's true regardless of whether you do have an in-state location. Any sales made from outside the state of Tennessee are treated as though there's some imaginary one location that's non-Tennessee, and all of those receipts are treated as being from one location and subject to the state level tax, and that's only a one-time tax. But if you have a location that's in a city, which will obviously also be within a county, then it's going to be subject to both the city and the county tax, and it's literally the same receipts are just double taxed, and it's the way that the tax is set up, and it seems unfair, but it is true. But if you have a location that's in a county but outside the city limits, then it's also only subject to the county tax, not the city tax.
And we've got another question. What about if you use Amazon FBA? Is that considered a location? That's
a good question. I don't know. Do you own the products at that Amazon location? Because
yeah, sometimes you can. So I know for California's business for their I'm having a total mind blank right now. For their I keep wanting to say Bright Line Standard Test, but
economic nexus.
Thank you. No, they're
factor presence.
Thank you. Oh my gosh. Yes, for their factor presence test, they do look at that. But yes, you could own the inventory if it depends on like what, not 100% of the time, but yes, sellers on FBA sellers can potentially own the inventory, because that was the whole issue, is that this was being done. Amazon was shipping inventory of sellers into different states, and sometimes without, you know, they wouldn't even know they had inventory there.
Mhm.
Yeah. So, I mean, to answer the question, I think I have not seen that come up yet in Tennessee. But I would think that the state would it would be aggressive, and they typically, with the business tax, they're typically trying to slowly creep into the aggressive territory and not be immediately jumping there. And so they have not, as far as I know, taken that position yet. But I would think that you would be able to, if you were the state, argue that that is a business location. As a taxpayer representative, I would argue that that's not your location at all, that you kind of outsource that to Amazon, and that you're making the sale from outside the state. And that's really the kind of fight that I have with them all the time. Just where do you declare the business location to be situated is something that we fight about a lot. And as someone pointed out, it's important because sometimes it means paying the tax once versus twice. And we have another question.
We have one question. Are services sourced on a cost or performance basis? If that's the case, then it seems like you wouldn't have any.
Yeah, so services are sourced based on where they're delivered. So if you deliver a service to a Tennessee customer, it's sourced to Tennessee. But again, that in and of itself raises questions, because obviously with the way the current world works, a lot of services are not easily sourced, and you can't really tell exactly, you know, where they're delivered. Is it the business address? Is it where the user is? Or, you know, all that stuff is again in the weeds that we fight about and hasn't been clearly established yet. So if you want to move on to the next slide.
Yeah.
So just again, a quick summary. To decide what rate the tax is imposed at, you have to look for each location at what classification that location falls into. And there's about 5 classifications that each have their own rate. And you look at what your receipts are, and whatever kind of activity generates the most percentage of your receipts, that's the classification you are. And sometimes these classifications, I mean, there is a catch-all for all services other than X, and there's a catch-all for all sales of tangible personal property. But there's also classifications that are literally like booksellers and laundromats and, you know, eyeglass repair shops. I mean, there's crazy things in there. So you really have to kind of go through and decide what your dominant business activity is to define what classification you're in, which sets the rate. And then after you do that, then you have to consider whether or not you're a wholesaler or a retailer. And again, the way you figure that out is what is more than 50% of your sales or your receipts. If it's from wholesale sales, then you're a wholesaler. If it's retail sales, and you're a retailer. And then you apply whatever that rate is to all your sales, regardless of whether they're wholesale or retail or class 3 or class 5. And again, you have to do that for every single location. So you might be a class 3 retailer in Memphis, but a class 2 wholesaler in Nashville. And so you literally just have to figure it out for every single location. So if you want to move on to the next one. Yeah, and this is kind of just a quick few points here. The good news is that it is only imposed on sales to Tennessee customers. So if you have a Tennessee location and then make a sale or the service delivered outside the state is not going to impose the tax on you for that transaction. I will say that before 2009, I had to fight with the Department of Revenue about that position, but now they're pretty clear that that's right, and that's in the law. A little weird nuances that sales of tangible personal property only to the government or charitable institutions or educational institutions are treated as wholesale sales. I think that's just a policy choice because the rate is smaller, but that's sometimes can flip you into a wholesale bucket when you wouldn't normally think of yourself as being a wholesaler. And then for services to affiliated entities, the good news is that unlike most kinds of services, you are only going to pay the tax on the markup if you're an affiliate. And so usually it doesn't get rid of the tax, but it largely addresses the hit you might get. So here are a few exemptions, and again, out of the interest of time, I'll try to go through them quickly. The wholesale to wholesale sale. So if you are a wholesaler that makes a sale to another wholesaler, that is not going to be subject to the business tax. I will say that the department seems to be looking at those kinds of transactions more closely these days and trying to find ways to declare them not to fall within the wholesaler to wholesaler bucket, but that is a clear exemption in the regulation. The problem with it, and a lot of my clients currently are struggling with this, is that it requires you as the business to make a determination about what kind of business your customer is, which a lot of times your customer is never going to tell you that information. And so the auditor comes in and says, we say that your customer is a retailer, and you literally, between your customer not sharing it with you and the state saying they can't share it with you because of the confidentiality statutes, you're kind of stuck trying to prove they in fact are a wholesaler when you have no data to actually allow you to do that. So it gets to be pretty frustrating and is pretty burdensome on the actual business.
And Steve, Oregon adopted a similar exclusion, and the seller has to get a certificate from the business stating that they're selling to, stating they're a wholesaler. And you know, one of my arguments has been that the seller has no incentive to provide that certification.
Right.
And so because they don't get the benefit of it, so why are they going to go through the trouble? And the department has created some very burdensome rules. So that one, maybe one we should talk offline about. Maybe Oregon can learn some things.
Sure, yeah, so it's actually interesting because originally the real exemption was wholesale to wholesale sales, which is what's written there. So you wouldn't look at the nature of the business, you'd look at the nature of the transaction. And slowly over time, and actually in the current regulation, it's morphed into wholesaler to wholesaler sales, which in some ways is easier because you don't have to actually look at each transaction. But as a seller, you know a little bit more about what your customer is going to do with that product than you do about what they do as a business as a whole. And so, and that way it adds that extra burden that sometimes unless you get a document from your customer, you can't really prove.
Yeah.
I'm going to go through this.
We have a question that plays into this. If you sell to a manufacturer that incorporates the product into their product that they sell to another wholesaler, does the wholesaler to wholesaler exemption apply?
It's a good question. I would argue that it does. I don't know that I've seen that. There it's really wholesaler to wholesaler to wholesaler, it sounds like. But I think the fact that it's incorporated into another product doesn't change the fact that you're selling it to that customer to then sell it to a non-end user. So I think it would apply. So super quickly here.
My question would be: is the first entity selling are they retail or are they a wholesaler?
Right.
Because if they aren't, would you lose that? Would you lose the qualification for that? But
I mean, just off the top of my head, I believe the definition of a retailer relies on some notion of selling it to the end user, you know, and so I think there, if you're selling to a manufacturer, I would argue that they're not the end user, but I could see someone saying they are because they're using it to make their product, but I don't think that's right.
yeah, that's why. So I'm thinking of it from the context of like a sales tax, and I know we recently had some cases in Illinois that said that because the product is being incorporated into a new product, that technically that second entity, so the middle entity, is actually the end user of the original product because they made a new product. So again, it can completely depend on the state, but that it's very nuanced when you look at it.
There is a regulation that says sales of items to hospitals, you know, that hospital is the end user, even though we know that they resell those items to their patients. I'm talking about drugs, you know, and so that there is that concept out there that you can be the end user because you incorporate it to provide a service or a new product with someone else. But I have not seen Tennessee take that position yet. Although again, they're chipping away at this exemption in a way that wouldn't surprise me if they look for an opportunity to do that. Super quickly, and this will be the last thing I say before I give Nikki 15 minutes to talk about 45 minutes worth of material. That is that another exemption that is worth pointing out is the exemption for sales of intangible personal property. And the fight there is about the treatment of software. At least that's the current fight, because in Tennessee, there's a Supreme Court decision from a long time ago that was in the sales tax context that found that the sales of software was the sale of an intangible. And almost immediately after that came out, the Tennessee General Assembly adopted a statute that said for sales tax purposes, software was going to be treated as tangible personal property. And so we have taken the position and have a few cases and issues going on right now where we are saying that is well and good for sales tax, but the statute says nothing about the business tax or any other tax. And so under that court decision, really just under a matter of logic, sales of software are intangible property and therefore not subject to the business tax. The department has rejected that argument to this point, but weirdly, they don't argue that it's the sale of tangible personal property. They actually argue that all software sales are sales of services, regardless of the nature of those sales. And so right now, there's a few cases pending in Chancery Court and other disputes going on below the surface. So hopefully this will get resolved at some point, although to this point it hasn't been resolved yet. So unless I really do want to give Nikki time. So why don't we just skip to Oregon unless someone else has questions. Great.
All right. So the Oregon cat, this is truly, I guess this is the Joey of the new kids on the block, the youngest. So this was enacted just last year in 2019, and we've already had 2 technical corrections bills. So there was one technical corrections bill that snuck in at the end of the legislative session last year. And then we had a technical corrections bill that passed this year, not during our regular session, but in a special session that took place at the end of June, which we were very lucky to get those corrections in because that session was obviously focused on other issues that are much more important than the Oregon cat. So big highlight, the Oregon cat does not replace the Oregon corporate income or excise tax. We call our general income tax the excise tax here. And this is in addition to that tax. And so not a replacement. The other big thing that has been going on is that since the enactment of the Oregon cat in 2019, the Department of Revenue has been very busy. They started rulemaking almost immediately. And after the passage of the legislation, engaged many stakeholders throughout the remainder of 2019, and then have had multiple rounds of rules that have been published since the beginning of this year. So we had temporary rules come out in January, February, and March. And then we've had some permanent rules come out in June and July. I will caution folks that some of the rules that came out this month will need to be revisited by the department because of that technical corrections bill. So let's move on to what is this? What is the Oregon cat? So I like to explain the Oregon cat with a joke. So indulge me. So the Oregon cat is like if the Ohio cat and the Texas margins tax were on Tinder, and you swipe whichever way you swipe to meet up. I don't know which way that is. And they got a room for a night. The Oregon cat is what would happen 9 months later. So you really do start with your commercial activity sourced to Oregon. This is pretty much just like Ohio. So the definition of commercial activity as well as our sourcing rules come from the Ohio cat provisions. But then due to a bit of a political fight, which as Breen mentioned, I may have been a little bit in the middle of, Oregon, the legislators, policymakers compromised. They understood some of the negative impacts of gross receipts taxes. So they provided a subtraction. Great, right? No, super complicated. So the subtraction is 35% of the greater of a taxpayer's cost of goods sold, essentially. We call them cost inputs here, or labor costs. And labor costs are capped at $500,000 per employee. Just to make it a little bit more complicated, you have to apportion your subtraction number. So you essentially situs your commercial activity to start, and then you apportion your subtraction. So your subtraction starts on an aggregate basis, and this is a tax that is filed on a combined basis. So we'll get to that in a minute. So once you subtract, you take your statutory subtraction is what I like to refer to it as. You get your tax base, that's your taxable commercial activity. Your tax then is equal to $250 plus 0.57% of your taxable commercial activity in excess of $1 million. If your taxable commercial activity amount, if that tax-based number is less than $1 million, you do not have any liability in Oregon for the Oregon commercial activity tax. For most cost members, that's not going to happen, but that is true. All right, so who is subject to this tax? Moving on, and Breen, you may be asking, why is this called the the corporate activity tax? It must. I know. I was thinking.
I am asking that.
Right, and so you're like, well, it must be called the corporate activity tax because it only applies to corporations. Wrong. I know you hate to be wrong, but you are wrong because I know. This is a tax that applies to everybody. And so another question you may be asking is, Nikki, I know you guys are all smoking funny stuff out in Portland and Oregon, but why'd they call it the corporate activity tax if it's really a commercial activity tax? Well, Brain, let me tell you. That's a really interesting question. See, when the legislators passed this, they were pretty sure they were going to be set up for an initiative ballot fight. And so what better way to get Oregon voters on board than to call something a corporate activity tax, even though all the pass-throughs and individuals are going to pay it. So the name is all politics, although I think there's some testimony that said we just didn't want to copy Ohio, but that's really not true at all. So this thing applies to everybody. A taxpayer is any person. Person is defined below on this slide. You can see it's very broadly defined. Or unitary group. And that is a real difference that Oregon's CAT has from many of the other gross receipts taxes out there. So
when you look at unitary group, are you looking at the threshold as a collective, or are you looking at each individual member of the unitary group?
Great question. So the unitary group definition is on the next slide, but when you look at that $1 million threshold, you're going to look at it on a group basis.
Okay.
And so here, Oregon picked up essentially the MTC definition of a unitary group for purposes of the CAT. And again, we learned that Oregon didn't get rid of their corporate excise tax. So you're thinking, well, that's easy. I just use the same group, right? Wrong. No, we have different unitary definitions for corporate income excise tax purposes and for CAT purposes. This one was not my fault, believe me. So and as passed in 2019, the other crazy thing was no water's edge election, nothing that limited this thing to anything but the worldwide group, which seems real dumb if you've got a bunch of foreign affiliates that aren't selling anything into Oregon. So happily, the legislature did address this with the technical corrections bill, that's House Bill 4202 earlier this year. And so we did not get a water's edge election, but we did get, and I have the exact language from the bill included on the slide. Essentially, if you are a worldwide group, if you have foreign affiliates, any foreign affiliate that is not selling into Oregon or has no Oregon source commercial activity, either directly or indirectly, they can be excluded from the group. And so just to put a point on the indirect piece of this, so if you've got a foreign affiliate that's selling, ultimately there's a sale into Oregon through an affiliate, that entity will come in, but that sale will get excluded because there is an intercompany exclusion for the foreign or for the affiliate for the group. So so we wanted to make sure that those entities were able to come in, so you could get that exclusion so that they didn't have a separate filing requirement in Oregon. So yeah, so unitary basis. Now commercial activity. So on the next slide here, commercial activity, again, broadly defined. We borrowed this definition from Ohio. So this is going to be all of the receipts of the taxpayer from transactions and activities in the regular course of their trade or business. I suspect there's going to be some fights over what the regular course of their trade or business is, since this also applies to individuals. I think we're going to see some activity there in litigation. The legislation also provides 47 exclusions to commercial activities. So there's a laundry list. Some of them are things you would expect to see. We do have this certified wholesaler exclusion, which I was chatting with Steve about earlier. Intercompany transactions are excluded. And then there's a lot of smaller exclusions, like an example on this slide is the motor fuel. So any any receipt that's picked up in one of Oregon's numerous other excise taxes. We don't have a general sales tax, but we have an item by item sales tax here in Oregon. I don't know if you knew that. So there's lots of things that are actually subject to some other tax. Those are generally excluded from commercial.
I have a question, Nikki. We had a question as to whether or not there's guidance on the 50% ownership.
50% ownership. They have drafted a rule on that. It's essentially a cut and paste from our corporate excise tax rules, and Oregon had previously adopted the MTC rules. But I know there is an open question out there as to whether or not how indirect ownership works, and I don't think that the department has addressed that specifically, but there are some rules out there. So moving on to taxable commercial activity. Again, your taxable commercial activity amount is going to be your commercial activity sourced to Oregon, and this slide includes the sourcing rules for your commercial activity. These rules essentially mirror our corporate income tax sourcing rules. So for, and you know, the big issue then becomes how are services and intangibles sourced, and so we do use market sourcing. The department has been provided specific rulemaking authority for financial institutions and insurers. They've issued a rule for financial institutions, but we have not yet seen one for insurers. And then I see a question about wholesaler exemptions required to provide. Yes, okay, this is a great question. So going back to the certified wholesale exclusion, in order to qualify, the department has drafted the rule very narrowly and said to qualify for that, you have to get the certificate at the time of the title transfers, which from my conversations with the department really seems to think that you walk up and hand something to someone else, and then they hand you a physical title. And so with that physical title, they can give you the certificate. That's how they think things operate in the world. Mm-hmm. And so they want that to happen. We've explained that that's not how things happen in the world, but when we do that, this is what they do. So they just stare at you blankly.
They actually hold you to the timing requirement? So if, yeah. Interesting, because in Tennessee, that is a requirement of the resale certificate, but the department pretty frequently just ignores that and allows you to kind of backdate things and prove that it really was a resale.
That's what they've said. Steve, we don't have a lot of experience with this yet, but this is one of those items that they've just kind of dug in on and said that they want it at the time of sale. So I hope that there can be some movement on that legislatively. Breen, we only have about 2 minutes left. So I don't know if we want to do dealer's choice. I know there were a couple questions about some of the local taxes. One slide that maybe on the corporate activity tax where to end, there's this registration, filing, and tax due date thresholds chart. I think it's a couple after this one.
You want me to skip up to that?
Yeah, I think that's a good one for people to be aware of. Should be the next slide, I believe.
I will say while you're looking for that, I think these slides are going to be available tomorrow, the whole deck.
Yeah, if you want, if you'd like a copy of the presentation, you just need to reach out to Hillary again and just let her know that you would like it, and we can send a copy to you.
And Breen, it's just one more slide. Yes, that one. So just for folks to have on their radar, so there's a couple thresholds to have in mind. And these numbers are just based on your, the first three are based on just your Oregon commercial activity or a commercial activity sourced to Oregon. So if you have less than $750,000 of that, you have no requirement. You will have nexus with the state under some other provisions of our nexus threshold, but you have no registration requirement whatsoever. Once you hit that 750,000 mark, again, this is just the Oregon commercial activity, then you have to register with the state of Oregon. And this is done on their online through their Department of Revenue online services. once you hit $1 million of Oregon source commercial activity, again, without that subtraction, you have to file a commercial activity tax return. You may not owe any tax, but you have a filing requirement. And then you only hit that filing requirement once you have $1 million of taxable commercial activity. And that is where you will take into consideration that subtraction.
And Nikki, we had a question as to if do you expect them to be issuing any guidance on insurance companies or insurers? I think insurance companies.
Oh, insurance, there's actually a lot going on in the insurance world. And so if that person could possibly email me, I'm happy to fill them in on that. There's just a lot of moving pieces on the insurance side with some of the domestic insurers. And some things they're trying to accomplish here in the state with respect to how insurance gets, receipts get treated. But we haven't seen anything specific come out of the department. So if that person would like to reach out, I'd happy to talk to them more.
Okay,
and I'm sorry we didn't get to
no, yeah, sorry, you know, with that, we're at the end of the presentation. We know there was some content we didn't get to. We just were all so psyched about gross receipts taxes. So if you have any specific questions regarding the slides we didn't get to or any of the content that we did discuss, please feel free to reach out to any of us, all of us, whatever you want, and we will make sure to get you those answers. Also, if you want a copy of the presentation, please email Hillary. Her email address was in all of the email reminders that you received for this presentation, and let her know that you would like a copy, and we will make sure to get that to you. And with that, we just want to say thank you so much for Zooming in with us today, and we hope you enjoyed yourself. Bye.
Thank you. Bye.
Thank you.